You finally do the responsible thing. You start saving money. Every month, you move a little bit into your savings account, $100 here, $200 there. You feel good about it, responsible, disciplined, financially mature. But then one day, you open your banking app and realize something strange. Your savings account has $10,000 sitting there, and it's earning something like 0.5% interest. That means after an entire year, you've made $50. Meanwhile, you keep hearing people talk about investing stocks, index funds, compound growth. And suddenly you start wondering, wait, am I doing this wrong? Because saving money is good, but saving alone rarely builds real wealth. And this is where a lot of people get stuck. They know saving is important, but they have no idea how to transition from saving to investing. So let's break down the exact step-by-step path to turn saving into investing without feeling overwhelmed or risking your financial security. Let's start with something that might sound controversial. Saving money alone will almost never make you wealthy. Look, saving is important, but it's not the final goal. It's just the first stage. Savings protect your money. Investments grow your money. And those are two very different jobs. Imagine you save $10,000 in a typical savings account earning 1% interest. After 1 year, you have $10,100. Not bad. But now compare that with investing. Historically, the S&P 500 has returned about 10% per year, on average over long periods. If that same $10,000 earned 10% annually, after 1 year you'd have $11,000. That difference might not seem huge at first, but the real magic is compounding over time. After 20 years, savings at 1% equals about $12,200. Investing at 10% equals about $67,000. Same starting money, completely different outcome. The biggest wealth gap isn't usually between people who save and people who spend. It's between people who save and people who invest. But here's the problem. Most people never make that transition. And the reason isn't math, it's psychology. Saving feels safe. Investing feels risky. When your money sits in a savings account, you can see it. It doesn't fluctuate. It doesn't drop 5% on a random Tuesday afternoon. But investments move sometimes up, sometimes down. And that emotional volatility scares people away. You might be thinking, okay, but I don't want to lose my savings. Totally fair. That's exactly why the transition from saving to investing should happen in stages, not all at once. Here's the step-by-step path. First, build a real emergency fund. Before you invest a single dollar, you should have 3 to 6 months of living expenses saved in cash. This money stays in savings. It's not for investing or opportunities. It's for unexpected problems. Job loss, medical emergencies, car repairs. The biggest reason people panic sell investments is because they need the money too soon. An emergency fund protects your investments from your own life. Second, separate saving from investing mentally. Think of saving and investing as two different buckets. Bucket 1 is safety money. It doesn't move. Bucket 2 is growth money. It's allowed to fluctuate because its job is to grow over time. This mental separation reduces anxiety dramatically. Third, start investing small. A lot of beginners think investing requires thousands of dollars. It doesn't. Many brokerage platforms allow you to start with $50 or $100. The goal isn't massive profits at first. It's building the habit. Because habits matter more than timing. Fourth, focus on simple investments first. Beginners often jump straight into complicated strategies. Day trading, options trading, crypto speculation. But the simplest investments often outperform complicated ones. For example, index funds track the overall stock market. Instead of trying to pick winning companies, you're investing in hundreds at once. Diversification, lower risk, long-term growth. Legendary investor Warren Buffett has repeatedly recommended low-cost index funds for most investors. The most powerful investing strategy is actually pretty boring. It's called consistent investing. Imagine you invest $300 per month into the stock market. If the market averages 8% per year, after 25 years you'd have roughly $285,000. Here's the crazy part. You only contributed $90,000. The rest, almost $195,000, comes from investment growth. That's compounding working in your favor, but psychology still matters. Investing feels uncomfortable at first. Markets go down. News headlines get dramatic. People panic. And this is where discipline separates investors from gamblers. Here's an analogy. Saving money is like storing seeds in a jar. You're protecting them, but nothing grows. Investing is like planting those seeds in soil. At first, it looks messy. You don't see results immediately, but over time, things grow. Eventually, you have something far bigger than the original seeds. Now you might think, what if I start investing and the market crashes? Great question. Market crashes are normal. They've happened dozens of times in history. But long-term investors actually benefit from downturns. When markets drop, your monthly investments buy more shares at lower prices, which often leads to stronger returns when markets recover. That's why many experienced investors stay calm during volatility. They're thinking in decades, not days. So to summarize, first, build a 3 to 6 month emergency fund. Second, separate your money into safety and growth buckets. Third, start investing small amounts consistently. Fourth, focus on simple long-term investments like index funds. And fifth, stay disciplined. Give compounding time to work. Saving money gives you stability, but investing gives you freedom. The earlier you combine both, the more powerful your financial future becomes. The moment you transition from saving to investing, that's when your money really starts working for you.